something just happened in the gold and silver markets that almost nobody is talking about. And if you're not paying attention right now, you might seriously regret it later. We're talking about a move so unusual, so perfectly timed around the Lunar New Year, that veteran traders are stopping in their tracks and asking each other, "Did you see that?" Because here's the thing, every single year, the markets do something predictable around Chinese New Year. Demand surges, prices shift, the usual suspects show up and play their usual game. But this year was different. Gold didn't just move, it moved in a way that broke a pattern that's held for nearly a decade. Silver followed, but not the way you'd expect. And underneath all of it, there are forces building, quiet, powerful, almost invisible forces that could reshape how you think about precious metals for the rest of 2025 and well beyond. Now, I've been covering gold and silver for years, and I'll be straight with you. What I'm seeing right now has my full attention. The data is clear, the signals are real, and the window to understand what's happening before the mainstream catches on is closing fast. Whether you're a seasoned precious metals investor or you're just starting to wonder if gold and silver deserve a place in your financial life, this video is for you. Stay with me all the way through because the full picture is stunning. And before we dive in, if you find real value in honest, deep dive financial content like this, go ahead and hit that like button right now. It genuinely helps this channel reach more people who need to hear this. All right, let's get into it. Let's start with some context, because to truly understand why what just happened is so unusual, you need to understand what normally happens during the Lunar New Year period, and why gold and silver have always had a complicated, fascinating relationship with this holiday. The Lunar New Year is the single biggest cultural and economic event on the Chinese calendar. In 2025, it marked the Year of the Snake, celebrated not just in China, but across Vietnam, South Korea, Singapore, Malaysia, Indonesia, and Chinese communities all over the world. We're talking about billions of people entering a period of gift-giving, family gatherings, financial reflection, and, critically, the purchase of gold. Gold jewelry, gold coins, gold bars. In Chinese culture, gold isn't just an investment. It's a symbol of prosperity, luck, and abundance. Giving gold during the new year is considered one of the most auspicious gestures you can make. So every single year, in the weeks leading up to and immediately following the Lunar New Year, physical gold demand from Asia surges. Jewelers sell out. Mints produce special edition coins. Retail buyers flood into shops in Beijing, Shanghai, Hong Kong, Hanoi, and Singapore. This is not speculation. It's a documented, repeating pattern that precious metals analysts have tracked for years. And silver? Silver typically gets a smaller but still meaningful boost, partly because it follows gold's general sentiment and partly because silver jewelry and decorative items also see increased demand during festive seasons across Asia. So here's what normal looks like. Gold prices tend to firm up in the weeks before Lunar New Year as Asian buying accelerates, then sometimes dip slightly right after the holiday as that seasonal demand cools off. It's almost clockwork. Traders know it. Institutions know it. The smart money positions around it every single year. But in 2025, that script got torn up and thrown out the window. Instead of the usual pre-holiday firmness followed by a post-holiday cooling, gold staged one of the most aggressive and sustained rallies going into the Lunar New Year that we've seen in a very long time. And it didn't stop after the holiday. It kept going. And silver, rather than just tagging along politely behind gold, began showing signs of what technical analysts call a breakout coiling pattern, a situation where the metal compresses into a tighter and tighter trading range before an explosive move in one direction. The question, of course, is which direction, but the setup itself is remarkable, and the timing, right here, right now, in the weeks surrounding the Year of the Snake, is anything but coincidental. So what's driving this? Why did the usual Lunar New Year playbook fail to play out the way it has for years? And more importantly, what does it mean going forward? Let's talk about the first major factor, central bank buying, and specifically what China has been doing behind the scenes. The People's Bank of China has been one of the most aggressive gold accumulators on the planet over the last 2 years. After a brief pause that had some analysts scratching their heads and wondering if China had quietly stepped back from the market, the PBOC resumed its gold purchases with notable intensity heading into 2025. And here's what makes this so significant. China isn't buying gold because it expects gold prices to rise. China is buying gold because it is strategically repositioning its reserve assets away from US dollar-denominated holdings. This is part of a much bigger geopolitical story about de-dollarization, about the BRICS nations attempting to build alternative financial infrastructure, and about China's long-term ambition to elevate the yuan's role in global trade. Gold is the ultimate neutral reserve asset. It has no political allegiance. It can't be sanctioned. It can't be frozen in a foreign bank account the way dollar reserves can. And after watching what happened to Russia's dollar reserves following the 2022 invasion of Ukraine, when the West essentially froze hundreds of billions of dollars in Russian central bank assets, every major non-Western central bank on Earth took a long, hard look at their own dollar exposure. China took the longest look of all. So when the Lunar New Year rolled around in 2025 and retail buyers in China were flooding into jewelry shops and coin dealers, they were doing so on top of an already tight physical market being quietly but relentlessly absorbed by institutional and sovereign buyers. That's a supply-demand dynamic that's fundamentally different from previous years, and it goes a long way toward explaining why the seasonal pattern broke down. But that's only part of the story. The second major factor is what's happening in the United States, and specifically with the Federal Reserve and the trajectory of interest rates. Now I know, interest rates and gold is a topic we've covered before, and some of you might be tempted to tune out because you've heard this story. But stick with me, because the interest rate picture in early 2025 is genuinely different from what most people expected just 6 months ago, and it has direct implications for where gold and silver go from here. Going into 2025, the market consensus was that the Fed would be cutting rates steadily throughout the year, with perhaps 3 or 4 cuts bringing the federal funds rate meaningfully lower by year-end. That expectation was a significant part of why gold broke out above $2,500 per ounce in 2024 and kept climbing. Lower interest rates reduce the opportunity cost of holding gold. When your money market fund or treasury bill is yielding 5%, the argument for holding a non-yielding asset like gold becomes harder to make. But when rates are falling, gold becomes relatively more attractive and capital starts flowing in. Here's what happened. The Fed's rate-cutting path got complicated. Inflation proved stickier than expected. The labor market stayed strong longer than most models predicted. And the political and economic uncertainty surrounding trade policy, particularly around tariffs and their potential inflationary effects, gave the Fed serious reasons to pause and reassess. The market's expectations for rate cuts got pushed back, scaled down, and then revised again. And yet, gold kept going up. Silver started waking up. That divergence, precious metals rallying even as the rate cut thesis got diluted, is one of the most important signals in the market right now, because it tells you that the gold and silver rally isn't just a rate cut trade anymore. There's something deeper going on. That something deeper is the third major factor, and arguably the most important one: fiscal reality in the United States and the growing global anxiety about sovereign debt. The United States is currently running a federal deficit that is, by any historical standard outside of wartime, staggering. The national debt has crossed $36 trillion and is climbing at a pace that makes previous debt trajectories look almost quaint. And while American debt has always carried the implicit backstop of dollar reserve status, the so-called exorbitant privilege, there are growing questions, asked more loudly and by more credible voices than ever before, about how long that privilege can be sustained. Here's the uncomfortable arithmetic. The U.S. government is now spending more on interest payments on its debt than it spends on national defense. Let that sink in for a moment. The largest military in human history, with bases in over 70 countries and an annual defense budget that dwarfs the next 10 nations combined. That entire apparatus costs less than what America pays just to service the interest on its existing debt. That is not a stable situation. And investors around the world, sovereign wealth funds, central banks, family offices, institutional allocators, are all quietly asking the same question. If America can't get its fiscal house in order, what does that mean for the long-term value of the dollar? And if the dollar weakens structurally over years and decades, what happens to assets priced in dollars? Gold has a pretty clear answer to that question. It has always served as the ultimate hedge against currency debasement, and right now, currency debasement is not a fringe concern. It's a mainstream worry. Add to this the geopolitical uncertainty that has become a near-permanent feature of the global landscape. Ongoing conflict in Eastern Europe, tensions in the Middle East, the slow-motion decoupling of the US and Chinese economies, and a broader fracturing of the post-Cold War international order. And you have a recipe for sustained structural demand for gold that goes well beyond seasonal patterns or interest rate calculations. Now let's bring silver back into this conversation, because silver's story in 2025 is in some ways even more compelling than gold's, and far less understood by mainstream investors. Silver is a dual-natured asset. On one hand, it functions as a monetary metal alongside gold, a store of value, a hedge against inflation and currency risk. On the other hand, it's a deeply industrial metal with applications across solar panels, electric vehicles, semiconductors, medical devices, and a host of other growing industries. And here's the fascinating tension that's building right now. The industrial demand for silver is growing at an extraordinary pace, driven primarily by the global energy transition. Solar panel manufacturing is the single biggest new driver of silver demand in the modern era. Every solar panel requires silver. There's no substitute with the same combination of conductivity and efficiency. And the world is building solar panels at a rate that would have seemed almost science fiction just a decade ago. China alone has been installing solar capacity at a pace that has consistently outrun even the most optimistic projections. India is ramping up aggressively. Europe is accelerating its renewable energy build-out. The United States is adding solar capacity quarter after quarter. All of that solar glass, all of those panels, all of that clean energy infrastructure requires silver, physical silver, mined from the ground, refined, and turned into paste that gets applied to photovoltaic cells. At the same time, silver mine supply is not keeping pace. Major silver deposits are genuinely difficult to find, expensive to develop, and often come with significant environmental and regulatory hurdles. Many of the world's largest silver mines are aging, with declining ore grades that mean you have to process more rock to get the same amount of metal. Primary silver mines, operations where silver is the main product rather than a byproduct of copper, lead, or zinc mining, are relatively rare. Most silver comes as a byproduct of other mining activities, which means that silver supply is partly hostage to decisions made by mining companies that aren't primarily focused on silver at all. Put growing industrial demand together with constrained supply and add in the monetary demand that comes from investors buying silver as a gold alternative and a speculative play on precious metals broadly, and you have the ingredients for a genuinely significant supply squeeze. Some analysts who follow the silver market very closely have been talking about this dynamic for years. The consensus view for a long time was that it was a slow-building story that would take time to fully manifest. What's different right now is that the timelines are accelerating. The energy transition is moving faster than expected. Industrial silver demand is growing faster than expected. And the monetary and investment case for silver is getting stronger, not weaker, as global financial instability persists. The Lunar New Year period, in this context, was almost like a pressure valve releasing. All of this structural demand, the central bank buying, the fiscal anxiety, the industrial silver build-out, the weakening dollar narrative, all of it was already present and building. The Lunar New Year added a fresh surge of retail and cultural demand on top of an already stressed physical market. And the result was a price action story that caught a lot of traders off guard because they were playing the seasonal script while the fundamentals had quietly rewritten the underlying reality. Let's talk about what this means for regular investors, people who aren't running hedge funds or managing sovereign wealth portfolios, but who are trying to make smart decisions about protecting and growing their own financial futures. The first thing to understand is that there are multiple ways to get exposure to gold and silver, and they behave quite differently. Physical gold and silver, coins, bars, bullion, give you direct ownership of the metal. There's no counterparty risk. If you own a gold coin, you own it outright. Nothing else has to go right for you to have that asset. In times of genuine financial crisis, physical metal ownership is the most robust form of exposure. The trade-off is that physical metal requires secure storage, can be less liquid than financial instruments, and doesn't generate any yield. Then there are ETFs, exchange-traded funds that hold physical metal on your behalf. The two most prominent are GLD and IAU for gold, and SLV for silver. These are liquid, easy to buy and sell through any brokerage account, and closely track the price of the underlying metal. They're not perfect replicas of physical ownership, but for most investors, they're a practical and effective way to get market exposure. Mining stocks are a third option, and a very different one. When you buy shares in a gold or silver mining company, you're not buying the metal itself. You're buying a business that extracts metal from the ground. Mining stocks tend to offer leveraged exposure to metal prices, meaning they often rise more than gold or silver when prices go up, but they also fall more when prices decline. They come with company-specific risks: management quality, geological risk, cost inflation, regulatory issues, geopolitical risk in the countries where they operate. For investors who understand these dynamics and are comfortable with the added complexity, mining stocks can be a powerful way to amplify exposure to a metals bull market. For investors who just want straightforward exposure, ETFs or physical metal are simpler choices. The second thing to understand is the role that gold and silver should play in a broader portfolio context. This is not an asset class for putting your entire financial life into. Even the most bullish precious metals analysts generally recommend that investors allocate somewhere in the range of 5 to 15% of their investable assets to gold and silver. The purpose is diversification and insurance, a counterbalance to the volatility and currency risk inherent in traditional paper assets. The goal isn't to replace your stocks and bonds. It's to own something that tends to perform well precisely when those other assets come under pressure. And right now, the case for that insurance is stronger than it's been in quite some time. Not because the world is ending, it isn't, but because the combination of fiscal instability, geopolitical fracture, monetary uncertainty, and genuine industrial supply-demand tension in silver creates a backdrop where precious metals deserve a serious look from anyone who cares about the long-term purchasing power of their wealth. The Lunar New Year of 2025 gave us a window into forces that are bigger and more persistent than seasonal buying patterns. It revealed, for those paying close attention, that the precious metals market has fundamentally shifted. The old playbooks, buy before Lunar New Year, sell after, sell gold when the Fed hikes, buy when it cuts, those simple rules are breaking down because the underlying reality has gotten more complex. We are living through a period of genuine structural change in the global financial system. The dollar's dominance is being challenged. Debt levels in major economies are reaching points of genuine concern. The energy transition is creating new industrial demand profiles for commodities like silver that didn't exist a generation ago. And geopolitical realignment is pushing central banks and sovereign funds toward hard assets in ways that are quiet but relentless. Gold and silver are not magic. They don't solve every problem. They can be volatile. They can go sideways for extended periods. But as stores of value with thousands of years of human trust behind them, as assets with no counterparty risk and no political allegiance, and as beneficiaries of both monetary and industrial tailwinds that are growing stronger by the year, they deserve to be taken seriously. What happened around this Lunar New Year was unusual, but unusual doesn't mean random. It means the rules changed, and the investors who recognize that the rules have changed and adjust accordingly are the ones who tend to come out ahead when the dust settles. Pay attention to gold and silver right now. The Year of the Snake has a way of catching people off guard. Don't let it catch you.